Good morning, everybody, or early afternoon, wherever you're at. Welcome. Thank you for joining. We're approaching 100 people already. Thank you. Feel free to start some chatter in the Zoom chat. Where are you calling from? What you have for breakfast? What are you looking forward to this week? Vacation is on deck for Joseph. I'm jealous. Mario, you're in SF, so am I. Hi from Michigan. Hi from Houston. Welcome. Someone said they had a bagel. Yum. West Virginia. Jennifer, looking for some clarity. You came to the right place. This session is not set up to be a Q&A, but if we've got time, please drop your questions. You can use the Q&A feature within Zoom, and if we've got time at the end, we can dig into some live Q&A. Hello from Ohio, Jennifer from Colorado. Yvonne from Atlanta, you're looking forward to this discussion. I'm excited to hear some of your questions. Yes, Dan, there will be a recording. So if you've got to hop early, we usually post all these webinars on our YouTube. So if you've missed some in the past, feel free to go to YouTube. You can rewatch the recording for different subjects. I think a couple weeks ago, we did a great session on marketing as a solopreneur. So there's a lot of great content on our YouTube. Teresa from Fort Lauderdale, welcome. Can we submit questions after the webinar if we can't have time for our Q&A? Post all your questions in the Q&A as we go through. If we don't get to them, we'll figure out a way to get you those answers. Welcome, welcome. All right, well, we've got a good group, 234 participants. Stefan, you're in Northwest Indiana. Nice to meet you. Welcome. Joseph, you hope you can figure out how to properly structure your LLC or S Corp. Hopefully we answer your questions. You'll be invited to schedule a call, a one-on-one conversation with one of our advisors at the end of this. We've got a great Call Me Now feature. So throughout the session, if you're just like anxious to talk to somebody one-on-one, you'll have the opportunity to do so. Jose, post your questions in the Q&A chat. That way I don't miss them. And we'll get started. Excited for a great session. Welcome, everybody. So today we're going to talk about LLC versus S Corp, which structure fits your needs the best. Brief agenda, a little blurb about Collective, what we do, how we support self-employed individuals, the pros and cons of LLC versus S Corp. There's not a one-size-fits-all solution. So every situation is unique. So we're going to talk about what to consider when you're deciding which one is right for you, how the S Corp savings work, additional advantages of being an S Corp, when it makes sense to consider the switch, and then how to do it. So we're going to dive in. If you've got questions, again, I'll reiterate, put them in the Q&A. I might miss them if they're in the chat. We will do our best to moderate and move them to Q&A, but if you've got a question you're anxious to hear the answer for, please use the Q&A feature. All right, so real quick about Collective, who are we? You're here probably because you've seen an ad. We are a financial platform that supports solopreneurs, specifically in operating the S Corp under the S Corp election. Why do we do it? High level, the S Corp has a lot of administrative burden. And the idea behind Collective is we bundle it all together under one login, one app, one subscription, so that you can stay compliant and focus on growing your business. So this webinar is for educational purposes only. Nothing contained in this or any related webinar should be viewed as legal or tax advice. Please always consider consulting a professional if you need legal or tax advice in operating your freelance business. So let's dive in. I see some great questions hitting the Q&A already, so keep them coming and we will answer them at the end. Okay, so let's start with maybe the second simplest structure. Single member LLCs, what does that mean? This means if you formed a single member LLC, you've taken one step further from being a sole proprietor. So, for context, a sole proprietor means you're running your business with no formal entity established, which is totally fine. It means you're operating under your social security number, maybe. You've not filed any official paperwork with the state. All of this is fine. It's the simplest form of being self employed. One step further is forming an LLC at the state level. So every state has like a Secretary of State board. Typically, we want to see people forming an LLC with their resident state because that's where you pay the tax. But when you're a single member LLC, things are still relatively simple. There's pros and cons depending on your situation. The pros, it's relatively inexpensive and easy to set up. You could do it simply through Zen Business, LegalZoom, or directly with the Secretary of State. Um, it's less paperwork. You only have to file one tax return every year. When you're a single member LLC, your business activity gets lumped into your personal filing. You would put it on a Schedule C and file it with your tax return that's due every April. So it doesn't trigger any additional business tax returns generally. The way you pay yourself is a lot simpler when you're a single member LLC. You simply take money out of the business bank account and put it in your personal bank account. In the tax and accounting world, we call that an owner distribution, which means under this structure, you're not paying yourself a formal salary under like a payroll software. Lastly, your tax is a disregarded entity. So what does this mean? It's similar to if you're a sole proprietor when you haven't set any legal foundation up. Being taxed as a disregarded entity means that the IRS views you and your business as one taxable unit. What's the advantage of this? Less tax filing requirements. The downside, we're going to pivot to the cons of this. All your profits are probably subject to self-employment tax. So this is the 15% that's made up of Social Security tax and Medicare tax. Then you still pay your income tax rate on top of that. So the con of this simpler filing is probably a higher tax burden. Another con, there's fewer tax planning opportunities as you grow, meaning there's no way to shift some of that tax burden via a salary like you can in an S Corp. It could appear less formal. Like if you're looking to buy a house or an investment property, proving your income under this structure could be a little bit more difficult. And you can't pay yourself a W-2 salary under this structure. It's something that the IRS prohibits, and they require you to make that S Corp election in order to get yourself on a W-2 salary. I see some great questions coming in. Thank you for the participation. Real quick, I'm going to pause again. If you're posting questions that you would like answered in the chat, copy and paste them into the Q&A. That's where we're going to be reviewing all the questions. So I see some great ones hitting the chat. We're just going to be referring to the Q&A section. So pros and cons of S Corps. The pros, the obvious one, is the potential opportunity to reduce your self-employment tax. And we'll talk more in depth on how that works specifically. But you can lower the self-employment tax burden when you elect S Corp status. When you put yourself on salary, you still pay payroll tax on that wage, but that becomes a deduction for your business. So that's a write-off that's going to reduce what you're taxed on. So that's a huge advantage. Similar to a sole proprietorship or a single member LLC, S Corp is still considered a pass-through business. So what does that mean? You might hear about C corporations, double taxation. This is an entirely different legal and tax structure, a C corporation, that's subject to a separate corporate level tax. What happens in this instance is that the business pays a corporate level income tax itself. With the IRS, it's 21%. The state level, it may vary, but you'll pay a corporate level income tax. And then the owners, when they take a distribution or a dividend, will pay tax again. So that's the true double taxation structure, C corporation. What's confusing is the IRS recycled the word corporation to apply to this S corporation tax status, and it's not subject to double taxation. So when you elect S Corp status, it's pass through, which means the business doesn't pay tax itself, but the income passes through to the owners, and then the tax is paid at the owner's individual level. So pass through taxation is a way out of this true double taxation structure. This structure requires that you report financial statements on a separate business tax return, which means you're building a stronger credibility and foundation for your business if you need future small business loans. Maybe you want to grow and have investors. Having this all documented on a separate tax return and financial statements can be hugely valuable. The cons of S Corp or why collective exists, it's just because it gets a little bit more complicated and a little more costly. Once you elect this S Corp status, it triggers a ton of additional administrative work. You have a need to pay yourself a salary as the owner, so that requires a payroll software. You file a separate business tax return. So every March, a business tax return is due before you file your personal return in April. That's its own separate cost. Maybe it's more complicated. The forms look a lot different than the individual return that you file every year. So you may need to engage CPA, collective, figure out how to DIY it. But all in all, it's an additional cost. You need more formal bookkeeping. So this business tax return relies on clean financial statements, which means your Google Sheets or Excel spreadsheet probably won't cut it anymore. I've done it. I used to do my dad's books, and then he became a collective member because that kind of accounting just doesn't cut it for what's required on the business tax return. What changes with bookkeeping is a common question we get. When you're a single member LLC, you just report that Schedule C, which is basically an income statement, income and expenses. It's relatively simple to track in a spreadsheet. When you pivot over to an S Corp, you now report both a profit and loss and a balance sheet. And so this is an accounting equation that's easily maintained when you have an accounting software that will do the ins and outs and keep track of the balance sheet. So that's why the bookkeeping becomes a little bit more robust, as we need to track two different financial statements versus one. When you become an S Corp, again, you pay yourself a reasonable salary as the owner. This is how you pay into the Social Security and Medicare tax under this structure. And we'll talk about, we'll show an example of how this works, but this is how the savings actually come into play. Some other limitations with S Corps. This part of the tax code was created specifically for small business owners. So they limit the type of stock or the classes of stock you can issue. So it's just one class of stock. And the owners are constricted. You have to be considered a non-resident alien or US citizen. Certain entity types, like certain types of trusts, can't be owners in an S Corp. So it's a little bit more confined on who can own it and how it can grow. Versus the C corporation we talked about, if you're looking to be like the next Google or Amazon, you want to issue different classes of stock, have an IPO. The alternate structure, the C corporation, is the path you would take versus a closely held business like an S Corp. The last con, again, we touched on this. Once you make the election, it triggers a lot of additional compliance, which means the IRS is just looking at you a little bit more closely. They've got two tax returns assigned to your name as an owner that they will be reviewing. So now we're going to get into a little bit more compliance tax talks. How do S Corp tax savings work? I see a lot of great questions, a lot of great comments in the chat. Please put them in the Q&A if you haven't already, and then we'll get to those at the end. So how do S Corp tax savings work? So let's back up. We touched on this briefly on the single member LLC side. So paying taxes as a solopreneur, you pay two buckets of tax. Maybe three if you consider the state impact. So one is income tax. This is the tax that none of us can avoid if we have taxable income. Income tax is based on a couple factors. One is your filing status. So do you file single, head of household, married, filing joint. And then within each of those filing statuses are different tax brackets. And this is what determines your income tax combined with all your other household income. So for a solopreneur, if you file single, this might include your Schedule C income, your business income. Maybe you're still employed as an employee somewhere else. So you've got a W-2. Maybe you've got a Robinhood account with some investment activity, maybe a rental property with rental income. So your income tax is determined by that filing status and the total of all your income sources. Then separately, you're going to pay self-employment tax on your business profit. So we're just going to isolate the Schedule C activity. It's your side hustle, it's your full-time self-employed business. That business profit is going to separately be taxed, subject to self-employment tax. To reiterate, self-employment tax, also referred to as payroll tax, it depends on the context. Both of those terms are referring to a bundle of taxes: Medicare, which is 2.9%, and Social Security tax, which is the bulk, it's 12.4%. And combined, self-employment tax becomes 15%. Okay, so why is this a burden? What's happening is you've got multiple layers of tax assessed on the entirety of your income. We can also add in state level income tax. So now you've got 3 layers of tax subject to all your business profit. So if your tax bill feels high, this is why. So we're going to talk through an example. On the left is if you're set up as a sole proprietor or single member LLC. Those are grouped in one column because the tax reporting is the same. Whether you formed an LLC and you're the only owner or you didn't, everything still gets lumped onto your personal return on that Schedule C. So that's why they're all in this left column. The right column is if this individual adds the S Corp election. So in this example, this person's got business profit of $160,000. Real quick, let's define profit. Profit is the amount left over after you've deducted all of your eligible business expenses. So revenue is what you bill your clients, that's straight up cash in. Then you back out normal deductions like the cost of your Facebook marketing, your laptop, if you're a photographer, your camera equipment. Those are all the deductions, write-offs, business expenses. And what's left over is business profit. And that's what you're ultimately taxed on. So this person's landed at $160,000 of business profit. Under the left column, taxed as a single member LLC, they don't take a wage. Their income in entirety is subject to that 15% self-employment tax. So that's what's generating this $24,480 here at the bottom. If this person elects S Corp status, and let's say in this example, they pay themselves a salary, so running through payroll of $60,000. In this instance, now only $60,000 instead of the $160,000 is subject to the 15% self-employment tax, which is getting us to that $9,180. So what does this mean? We've generated $15,300 in self-employment tax that you just wouldn't pay under this structure. A common question that I'm sure is in the chat is what happens to that leftover $100,000 here? The entirety of your business profit is still yours as the business owner. You just receive it in 2 buckets. One bucket is going to be this formal salary, maybe it's $60,000 that's kind of running direct deposit in the background. It's going to have withholdings taken out. It's going to go direct deposit to your personal account, kind of just on a routine cadence. The remaining profit is available for you as the owner to take as a distribution. Again, distribution, all that means is you're moving money from business checking to personal checking for your own personal use. Now you still pay income tax on the entire $160,000. So this chart is overly simplified just to demonstrate what happens to the self-employment tax piece alone. And that's the part that the S Corp helps you control. So to confirm, there's still income tax on everything. That $160,000, you pay income tax. We're just carving out a smaller portion to pay the self-employment tax. Now, what are some strategies that self-employed individuals can implement to help with this tax burden? One, the best advice that you can ever get from anybody, doesn't matter, CPA, collective webinar, the best advice you can get is how lowering your business profit. So make sure you're aware of the deductions that you're entitled to take, because lowering your profit is what you're ultimately taxed on. So make sure you're capturing your deductions. One of the ways to accomplish this, I'm going to skip forward, is keeping accurate records. So if you've got clean books, you've got a clean perspective on what you're deducting. Maybe it gives you insights on where you can invest more. Maybe you want to open up a new service line, and maybe you need to take a course. Maybe there's room for continuing education in your business, and that becomes a deduction. Tax deferred retirement plan. So when you're self-employed, you don't give up traditional benefits. You can still implement them into your own business. A couple options depending on how you're structured: SEP IRA, solo 401k, regular 401k if you've got employees. These are pre-tax retirement contributions, which means you get a deduction in the year that you make a contribution, which means it's lowering your tax bill in the current year. And then you'll pay the tax later when you withdraw. This is not necessarily an option to lower your tax bill, but it's going to help alleviate, maybe from a cash flow perspective, what you might owe at the end. If you don't already, paying quarterly taxes is like prepaying into your tax bill throughout the year. If you've been employed, Mark, you've got a great question or comment. If you can put that in the Q&A and I'll address that. If you've been employed elsewhere and you've got a regular payroll cadence, you're paying in withholdings throughout every paycheck. When you're self-employed and it's your main source of income, you don't have a way to do that. And so the IRS wants you, they want to collect your money throughout the year. So they've set up these quarterly deadlines for you to prepay into your tax bill throughout the year. One, the IRS wants your money sooner than later. Second, it helps alleviate what you're going to owe at the end. So if you've been self-employed and you've been burned by a huge tax bill at year end, there's maybe a couple reasons. Maybe you're not in the right tax status yet, or maybe it's time to consider a different one. But maybe you're not paying quarterly estimates, and so you're still paying the same amount of tax. It's just reducing how much you owe at one point in time. What to do when you've exhausted all of these options, your tax bill is still killing you. Maybe it's time to reconsider the tax status. And so generally when profits over 60,000, this is not an IRS rule. It's kind of just a benchmark for having this conversation. Is it time to reconsider how I'm taxed? So taxes when you're an S Corp. Some of this we're just going to reiterate. We've touched on some of this already. There's no self-employment tax on the remaining S Corp profit, right? So what the S Corp allows you to do or requires you to do as the owner is pay yourself a reasonable salary. Then only that salary is subject to self-employment tax instead of the entirety of your business profit. So under an S Corp, you skip the self-employment tax on the remaining profit. What changes? You're wearing multiple hats. You're both the owner of your S Corp and you're an employee of the S Corp. What does that mean? The wage that you pay yourself and the related payroll tax, this is still, payroll tax is still Social Security and Medicare. That becomes a deduction, which lowers your taxable business profit. Again, only your salary is subject to the Social Security and Medicare tax. You will still pay income tax on everything. So there's no escaping that if you've got taxable income. So some additional benefits of S Corp. It's not just about savings. There are some additional advantages that can be substantial depending on where you're at, what your goals are. Professional credibility is a big one. If you're looking to grow, maybe your 5-year plan is to add an investor or grow your team or get a small business loan or a grant, you will be maintaining financial statements. You'll start establishing a separate tax history for your business. So this is all just building professional credibility. Maybe you're establishing business credit along the way with a business credit card. On the personal side, maybe you have goals to grow your asset book. Maybe you want investment properties, vacation homes. Sometimes I think lenders give self-employed individuals a harder time with giving them loans because the proof of income is a little bit more challenging. So when you're on an S Corp, you start to establish W-2 history. Combined with the S Corp tax return, maybe that helps with proof of income for future investments. Cleaner financial structure. You're really getting more organized and structure for your business. You're really creating a separation from business and personal. This can help alleviate that like scramble in December, January, February, March of you highlighting your bank statements and finding out what's personal and business. Once you get a more formal structure, it kind of naturally creates that separation. And again, foundation for growth. You've got a little bit more official on paper. Your processes are a little bit more streamlined. Maybe this helps you shift focus into how you actually want to grow the business part, not the admin and tax part of your business. So when does it make sense to make the switch and when it doesn't? Again, this is highly circumstantial. So nothing said here means it's the blanket rule for everybody. You know, there's some other nuances with how Social Security and Medicare is calculated. There are Social Security wage caps. They limit how much you can pay on Social Security tax, but there's no limit on Medicare. So there's a lot of nuance here. Whether or not you've got a high earning W-2 salary can play into this. Whether you're testing out self-employment can play into this. So we're going to talk about that. But before we do so, we're going to do a quick poll. Would you want to meet with a collective advisor after the webinar to see how much your business could save with an S Corp? And we're just going to give it a minute, a little bit of engagement here. I see 45 questions. So we're going to get through the rest of this deck and then we'll pivot over to Q&A maybe for the last 15 if that works for everybody. We may be able to stay on for an extra 5. So if you want to hang on, feel free to hang on. Yeah, we just want to gauge your interest. Would you want to meet with an advisor one-on-one to talk about your specific situation and see if this is the right fit for you? Sabrina, yes, there will be an opportunity to scan a QR code and book directly. Great. Well, we've closed out the poll. Thank you so much for the participation. You guys are doing the most, and I love it because sometimes it's crickets in the chat. So thank you. Lori, there will be a replay. Everything gets posted to YouTube, and we do send out a copy of the recording for the attendees. All right, we're going to move forward. So we were talking about when it makes sense to switch to S Corp and when it doesn't. So which is best for you? LLC, single member LLC, might be best for you if this is new. Maybe you're testing a theory or you've got a little traction, but you're not really fully committed to being self-employed yet. Setting up the LLC will give you a formal business name. It will give you a tax ID. It gives you a layer of liability protection so you can protect your personal assets from something that happens within your business. So this structure could be good if you're still new or testing the theory, you're not earning a ton of income yet, which means maybe you don't need to trigger a more complicated tax structure. The profit points. Again, the profit point isn't a rule with the IRS. You can run a business at a loss and have an S Corp. Really, if your motivation is how do I lower my tax bill, you want to consider your profit. Why? Generally, you want to see if the savings potential is going to exceed the cost to do the extra work. If you just want a simple, straightforward tax structure, LLC, single member LLC gets lumped into your personal return, so that may be the best path for you. S Corp may be best if you want to explore different or more options for maximizing retirement contributions. When you're an S Corp, the way you contribute to retirement changes a little bit, where you've got employee and employer contributions, meaning your S Corp can make a contribution to your 401k, you as the owner employee. And then whatever the S Corp contributes becomes a deduction for the business. Deductions are good because they lower your profit and that's what you're taxed on. So that's an advantage. Earning more than 60,000 in profit per year. Again, this is not an IRS rule. This is just an instance where the savings potential is going to start potentially exceeding the cost to do the extra work, right? So you're net saving. Another option to consider, are you generating enough or consistent income to run that payroll for yourself, right? Because once you switch to S Corp, you have to pay yourself a reasonable salary because that's how you pay into that Social Security and Medicare bucket. Mario and Myrna, if you can post that question in the Q&A, just want to make sure we don't miss it. And we might answer this question here in this next session. Step-by-step guide on how to form an S Corp. You will get a copy of this deck. This is a pretty wordy slide, and I'm going to click through so we can see all of it. So what's the first step? So an S Corp is an election, and it needs to be layered on top of a legal structure. So there's a couple options for legal structure. The one Collective works with is an LLC. The alternate is the legal corporation. That's the option you take if you want to like IPO. So legal corporation is what allows for various classes of stock, unlimited classes of stock, international investors. That foundation allows you to grow in that way. An LLC is better for a closely held business. If you intend it to be you, a business partner, your spouse, two other people, typically the LLC is the more appropriate structure. So the first step is forming that legal foundation. LLCs or legal corporations are formed at the state level. Typically, we advise to form in your resident state because that's where you pay the tax. You can form elsewhere, Delaware, Wyoming, those are popular. You can totally do that. What happens is you're still required to register that business in your home state. And then you're kind of just on the hook for 2 states, LLC renewals, fees. Maybe it's not a big deal to you, but that's just the downside of forming elsewhere is you're still required to register where you live. Either way, the first step is forming an LLC. What happens with that is you get your legal business name, you get your tax ID assigned to that, you create a layer of liability protection. So now you're truly separate from you as an individual and your business. The next step is setting up money flows. So you now are building the foundation to truly separate your business and personal activity. So you'll open a business bank account under that tax ID. You can also try to open a business credit card and start establishing business credit. Then at that point, you can open or you can apply for the S Corp election. The S Corp election is a simple 2-page form. You could do it yourself. That part, frankly, is easy. Filing the S Corp election is totally doable DIY. What is more challenging is the compliance that's triggered once that S Corp election is accepted by the IRS. So if you see like chatter threads on like, you can do this for free, you can do this yourself, it's so easy. Yes, that's totally true. You can file the S Corp election yourself. What's more complex is the compliance after. Make the S Corp election. Also listed here is applying for the payroll registration. So once you elect S Corp, you have to pay yourself a wage. That requires the use of a formal payroll software, which means you need to register as an employer with your state. So that's a whole separate registration. Then you set up all your compliance tools. So what do you need to stay compliant with an S Corp? And this is all the stuff that Collective would do for you under one fee, one login, all of that. So set up a payroll software. Included in your Collective membership is a subscription to Gusto. It's all embedded into the dashboard. Again, why is this required? You have to pay yourself a salary when you're operating under the S Corp structure. You need to set up more formal bookkeeping. So again, the spreadsheets won't cut it, or they will if you really know if it, like you've got an accounting background and that's fun for you. You could do it in a spreadsheet. I'd say a bookkeeping tool would make your life a lot easier. Again, this is why it's included in the Collective membership is we'll just maintain these financial statements for you monthly. Why is this important? The S Corp tax return that we have to separately file every year relies on these financial statements. So it's best that they're maintained throughout the year. And then make a plan for tax filing. So if you DIY your tax return every year, take a look at the S Corp tax return. It's called Form 1120S. And just do a gut check. Like, is this something you want to figure out how to do yourself? Maybe. Do you want to engage a CPA to do it? Maybe their prices are really high. Again, the business tax return is included in the collective membership so that everything you need to maintain compliance is bundled together in one place. And now we're just going to sit at the screen. If this is something that you want to talk to an advisor one-on-one about, scan this QR code. If you're interested in joining, this week we've got this promo code. It's going to take your first month free off of Collective. So I'm going to leave the screen up. Feel free to scan and book a call. And while we do that, I'm going to pivot over to the Q&A. There are 80 questions and we've got 9 minutes left. We can hang on if you want to hang on and listen to these questions. We'll stay long if we can. Okay, first question. If I work in the beauty industry as a cosmetologist, what would be my best route for my business? It depends. A lot of times in the beauty industry, you would be an employee of a salon maybe, or you're self-employed. I would consider, is this your full-time gig? Is this the side hustle? Oftentimes, if you're self-employed, meaning a salon or a studio or an agency isn't paying you, you're self-employed. So you may want to consider if this is full-time, you're making a lot of money already, your book of business is growing, maybe time to set up an LLC. That would be the first step regardless. It's going to give you liability protection, tax ID, separate business bank accounts. Once your profit grows, book a call with Collective. We'll see if it's time to add that S Corp election. In most instances, if you're growing a business, the LLC formation is going to be the first step anyway. Let's see. Sandra, is it too late to switch to S Corp for 2025? So an S Corp election needs to be layered on top of a legal structure. So Sandra, if you have an LLC already and it was formed prior to January 1st, 2025, you can, following a late relief process, elect S Corp status all the way to January 1, 2025. That's something Collective could help you with. So if you want to book a call and see if we're the right fit, the door is open. If you're operating as a sole proprietor, meaning nothing's formed yet, the earliest your S Corp election can be is the LLC formation date, meaning if you go to the Secretary of State website today and they approve your LLC today, your S Corp would start today, May 20th. And then it would be like a short tax year for this initial year. Anonymous attendee currently has an LLC in their resident state, but hasn't registered anything with the IRS. Is it too late to switch to S Corp? Nope. The way you're set up with your state only is correct. To reiterate, the IRS recognizes you as a disregarded entity when you're a single member LLC. So you've not done anything wrong. This is correct. All this means is that when you're at this stage of formation, the IRS still sees you and that single owned LLC is one taxable unit. So you're good. You can still follow the late relief process and elect S Corp status for 2025. Humberto, do you suggest I just start as an LLC as a first-time day one business owner and operator? It's an electrical company. I would consider, I guess, have you proven the concept of your business? Because once you form an LLC, you're agreeing to some annual reports and annual fees to keep that LLC open. If it's something like I'm just trying it out because I got one client, but I'm not really committed to it yet, there's nothing wrong with operating as a sole proprietor. So if you're still very early, like you don't know that you're going to keep it, you don't know if it's going to grow, you don't know if you want it to grow, there's nothing wrong with operating as a sole proprietor. If you get to the point where you're like, I'm comfortable with this, it's naturally growing, you've got organic referrals, yeah, maybe it's time to set up the LLC and then let time pass, see how you grow, see if you're fully committed to it, and then you can add that S Corp election. So an LLC is only at the state level. So if I move to another state, I need a new LLC number. So yes, LLCs are formed at the state level. Each state has their own. I think in Texas, it's called the comptroller. Most of the time, it's called Secretary of State. But they own the LLC formation process. If you move, there's a couple options. Depends on, I guess, how complicated you want to get with it. There's something, the simplest version when you move is called a foreign registration. All that does is tell your new state that you're doing business with an LLC that was opened elsewhere. Typically, when you move, that foreign registration is required because you want to stay compliant in your new resident state. So that's the simplest version. If you're in a state like, let's say, New York, and that's where your LLC was, maybe you don't want to be on the hook for New York's annual fees and requirements because they're expensive and annoying. In that instance, maybe you consider dissolving that old LLC and starting from scratch in the new. There's also something called a conversion or a domestication. Not all states allow this, but it formally moves the LLC from your old state to your new state, meaning it removes any compliance requirements in the original state and just moves it to the new. So there's a couple options. I would say, the context of your move, like do you still retain residency or any kind of presence in the old state? That's something to consider, and whether or not you register versus move or dissolve. But there are a lot of options when you move. I would say consult with a tax advisor, but there's a couple options. Judith, I own a business that's an LLC with an S Corp election already. You work with 1099 contractors and need help. Judith, scan this QR code and book time with us, and we'll see if we can help you out. Yes, this presentation will be sent out post-webinar. You can also go to YouTube and watch a replay. But yes, you'll get a copy of this slide deck. Let's see, do single owner LLCs typically do best doing that for the first 1-2 years while earning the first revenue and then switching to S Corp? Is there a typical recommended trajectory for new solopreneurs with new businesses? It's very common to just kind of sit at the LLC stage. Maybe you're proving the theory. Maybe you're still like balancing your full-time salaried role and you're trying to decide, do you take the leap to full-time self-employment? So yes, it's very, very common to just kind of sit at the single member LLC stage. A couple factors to consider when you do the switch to S Corp. You're fully committed. Now this is the full-time source of income. Maybe the revenue or the profits doubled from organic growth. So it's very common to kind of sit. I would say, is there a typical flow? Again, it's like very circumstantial. So I would say one-on-one conversation would be best to determine which version of this is right for you. But it's very common to sit at one stage and then transition to the other. James, you're a resident of California and doing business in pest control. California does not accept an LLC. Okay, this is a great question, James, and this is going to apply to a lot of folks here. If any of you operate under like a state issued, board issued license, your state may have requirements to set up your legal structure different. James, for us in California, if you're operating under a professional license, you can't form an LLC. As an alternative, they have a legal structure that's specific for people with a professional license. And in California, it's a professional corporation. If pest control and that licensure falls under that category, you would form a legal professional corporation at the state level. And then you would probably simultaneously elect S Corp status. So James, your question, if you formed the legal corporation, all you would do is file that S Corp election paperwork just like normal, Form 2553, to elect that pass-through taxation. Under single member LLC, you pay double tax, self-employment, personal, even if you have a separate full-time job. It's not double taxation like in the true essence like a C corporation, but it is multiple layers of tax. They're different taxes. The reason it's called double taxation in the corporate structure is you're paying income tax at the corporate level and paying income tax again at the individual level. So it's double income tax. With this structure, it's different types of taxes, which is why it may not fall under the true double taxation bucket. But you're right. If you're self-employed and got another source of income, you're still paying multiple layers of tax on all your income. There's 93 questions and there's more coming. I'm not sure that we're gonna get through all of them. I think I can stay on until 5 till. So I've got 9 more minutes to answer questions. We're gonna do our best to get through these. I'm just gonna say I appreciate the engagement. This is a big deal. Tori, should you have a certain amount of income before switching to S Corp from LLC? So again, it's the IRS doesn't require you to have a certain amount of income. So you can elect right now. It's really more of why are you considering S Corp? If you're looking for a savings opportunity, you want to consider your profit, because at a certain profit threshold, the savings potential is going to be more than what it costs to do all the compliance. So generally, like collective ads will say 60,000 of profit. That's generally the point at which your savings potential is going to exceed our membership cost. Jordan, you just set up your LLC in March, still unsure about how much money I'll make this year for contracting work, estimated about 50K. Should I elect S Corp for tax filing yet or wait? So if you're making 50,000, is that revenue or is that profit? Profit is the amount after you've considered all your write-offs. If that's revenue, generally, and if this is a side hustle, generally the savings potential probably isn't going to be more than what collective costs. So it may make sense to just pulse check throughout the year and decide, do I consider this now? Do I check again in June? Do I check again in August? If you're at 50,000 of revenue, it may be too early. Are these laws specific to one state? So every state has its own compliance requirements for the LLC, the legal structure itself. The S Corp election, it gets a little nuanced. So the IRS is the federal tax code, right? And then the states often decide, do they follow the federal tax code? Most states will recognize the S Corp election. Sometimes they will recognize it immediately when the IRS accepts it. Sometimes they require a separate S Corp election. Sometimes they don't recognize it at all, and that's more rare. So more often than not, your state will recognize the S Corp election. You may have to do a separate election, meaning that if you file the federal one, you may have to do extra paperwork for your state to recognize it. That's something that Collective would help you with if you were to join. Is it possible to convert LLC to S Corp or vice versa? Yes, so LLC, it's not really conversion, it's layered. So you still exist as an LLC underneath that's going to remain your legal foundation. That's what gives you the business name, the tax ID, the liability protection, that all stays. Then the S Corp election is layered on top. So it's not like it's a copy and replace. It's more of creating a stack. You've got your legal structure and then you've got your tax status on top. I need to be a US resident to file an S Corp. So it's either a US citizen or or resident alien. And there's certain qualifications to determine what constitutes a resident alien. Maybe you've got a green card. Typically, work visas don't constitute resident aliens. So I'd consult with maybe a tax attorney to determine whether or not you meet that criteria. But the IRS does have more strict rules on who can own an S Corp. So it's US citizen or resident alien. I've got 5 more minutes. We've got 243 people still on the call. Thank you for hanging in there. We're going to go for 5 more. We'll figure out a way to review the rest of the questions and see how we can get you answers. As always, you're invited to schedule a call one-on-one, talk about your specific situation. And we're just going to keep going. Dan, you're on an L2 visa, so I don't think I can apply for an S Corp. I can partner with IS investor, but don't want to give up majority ownership. Can you advise? Dan, frankly, I'm going to tell you this is beyond what I know. It might be best to speak with a tax attorney with experience in this. It's beyond the scope of collective, and it's beyond what I've experienced in my time in public accounting. So I would say time with a tax attorney might be advantageous. Meredith would love to know the process to go from S Corp to LLC. So the reverse, you can revoke an S Corp election. There are some steps that happen. If you revoke an S Corp election, you default to a C Corporation, which is the structure that is subject to the double taxation. So while you do that, you would also do another form to revert you back to an LLC. So it's kind of like a 3-step process. Maybe we might have some more information on that. It's a little bit more nuanced. So Meredith, maybe we can connect somehow. Feel free to reach out to us. Maybe we can get you some guidance there. I'm a sole proprietor, esthetician, when would I want to switch to S Corp if ever? I do not ever plan on having employees. So consider if this is your full-time business and how you start growing. If you're a sole proprietor, maybe the first step is just setting up an LLC. It's going to give you the tax ID. It sets the foundation for a future S Corp election. So maybe start there. Then in the future, you do pulse checks, like how is your business growing? Do you like it? Are you going to continue to grow your esthetician business? And you can book calls with collective at those benchmarks to see if it's the right time. So sometimes S Corp election is just a timing thing. You do not have to have additional employees to elect S Corp status. You would be an employee of your S Corp. So when you hear employees, it's referring to you as the owner because you have to pay yourself a salary. Is there a recommended income threshold before electing S Corp? It's not a rule, but it's kind of just where the savings potential exists in contrast to what it costs to do all the extra work. Generally 60,000 of profit, but you do want to consider a lot of other factors like how long you'll be self-employed, whether or not you have additional salaried income, that's a factor. There is no rule. It's just if you're looking for savings, they may not exist if you're earning too low because you're going to pay a lot more for compliance. Noreen, can you switch to S Corp or C Corp in the middle of the business, like in the middle of the tax year? Yeah, you can revoke the S Corp election at any point. What do you have to consider when you make a change like that? You're creating a split year activity. So if you decide like today, I don't want to be an S Corp anymore, I'm going to revoke it, you can do that. The IRS is going to approve a revocation date. And now you've got a split year of activity where January to May 20th gets reported on an S Corp tax return. That's going to trigger a tax deadline, maybe sometime in the next couple months to file that final S Corp return. And then you separately consider what do I need to do to stay compliant as a C Corp for May 21st to December 31st. So that's something to consider. You could totally do it. Usually the end of the tax year is a nice time to make a switch. Split year activity is not the end of the world. It's very common, especially for sole proprietors who decide to form an S Corp in the middle of the year. It's very common. S Corp to C Corp, I may consult a tax advisor to see if that's the right move. I've got 1 more minute. Erwin, thank you. I'm glad I answered one of your questions. Connect with us on LinkedIn, follow us on YouTube to get more questions. We'll figure out how to answer the rest of these questions. I'm gonna do one more and then I think we'll call it. Is a single member LLC also called a partnership? For example, 50-50 ownership with a spouse. This is a great one to end on. Thank you for this question, Samantha. It depends. So I think there's 11 community property states within the United States. What does community property mean? It means that if something's owned by a married couple, it's considered one owner, right? So in the instance, like I'm in California, which is community property state. If I owned something with a spouse, married spouse, it would be considered one owner. So if my LLC would be considered a disregarded entity, which means it's not a partnership. If I was in Florida, which is not a community property state, and a married couple owned an LLC, in that instance, it's a 50-50 partnership, meaning if you were to form an LLC with two owners, it's going to trigger a partnership tax return unless it elects S Corp status. If I formed an LLC here in California with my married spouse, I could still report on Schedule C and be taxed as a disregarded entity because the IRS views us, a married couple, as one taxpayer. So it depends on where you live. Quick Google search can determine if you live in a community property state. If not, and you form a business with your spouse or another business partner, you will default to a partnership. We went 11 minutes over, and there's 88 questions that are still unanswered, a ton of chatter in the chat. I can't thank you enough for the participation. It makes these conversations so much more valuable. Find the recording on YouTube. An email will be sent out with this deck. Scan this QR code, book some one-on-one time. And thank you for all the participation. We'll see you next time.